Per usual, everything on this channel is for educational purposes only and is not intended as financial advice. Teaching Tech Tuesday, I've been getting some questions about exit strategies. So let's review some of those, some that I like. You got to keep in mind, for most people, it's based on their comfortability levels with holding things for a certain period of time. But just to review, baseline for success, you need a system, you need to understand sizing, you need to have discipline, and you need to standardize what you're doing so that you have some non-random way of entering and exiting markets with an established edge. Many people never get past this point. Many people don't care about a system and they're just gambling, and that's fine. There's nothing wrong with that. But it's not trading. It's not setting yourself up for long-term viability here. So you definitely want to get to this point. That's why I like the cloud. That's why I like chart patterns. To me, those are an excellent system for long-term success, robustness, working in any market. For exits specifically, when you're setting up a trade, not an investment, you always want entry, exit, stop loss. Always. What I like to do, what I love to do, is take a high conviction setup on some form of leverage, whether that's just straight leverage or options or leverage ETF, whatever it is. You take that high conviction setup, leverage it up, and then once the momentum slows down, you move to spot, or you exercise your options, or you get out of leverage, and you're effectively sizing it down when the momentum slows down. There's obviously a yin and a yang here between letting your runners run, closing at the right time, closing too early. This, based on the individual, comes over time. It's not something really, I don't think, that you can be taught. I think it's something you have to learn. You can't really read a book about it. We could say, use this sort of math equation for this estimation of XYZ, blah, blah, blah. But when it comes down to it, it's about the individual. That's why this is tough. Everybody wants some sort of get-rich-quick scheme for trading, but that's not how it works. So the keep it simple strategy is sell half on a double. Remainder of your position is free money. That's an easy baseline rule, because then you can, at least for me, for most people, you can comfortably just let the position do whatever it needs to do over a longer period of time. You've taken out your original amount, and you can let it breathe. You can forget about it. Whatever it is, give it time. And like I've already said, drop the leverage or sizing when the momentum slows down. If the pond that you're in is empty and there ain't no more fish there, it's going to be tough for momentum to continue. MSTR is a great example of that. Even BTC here is a great example of that. Most of these altcoins, great example of that. If you don't have momentum on your side, you're eating fees on leverage, you're eating plenty of other stuff on options, and it's just a mess. The other thing I see a lot of people doing is dwelling on the past. Nobody ever went broke taking profit, and you have to keep that in mind. Again, this comes with experience and time. You're going to close trades early. You're going to close trades too late. But once you take 50 successful trades, 100 successful trades, then you get a better understanding of your own ability. The biggest issue here is, if we're talking about trading stages again, most people never quite make it to 3. And when they do, they certainly don't have a lot of experience managing large wins. So what you need to do ahead of time is review the game film, review charts. What would I have done in this environment? What would I have done in NVIDIA in 2 years ago? What would I have done in MSTR if I didn't trade it? What would I have done? And we'll talk about a few of these. You need to know what you're looking for. And that goes back to having a system, having some discipline, having some understanding of what to do, X, Y, and Z situation. Being able to read market conditions, like when is no momentum in the market? When are we flat? When are we sideways? When is volatility down? When are we ready for volatility expansion? That's super, super helpful, because then you know which tools to use or strengths and weaknesses in your system. If you can't approximate momentum, then you're going to have a hard time using many systems, is my guess. Over time, you establish intuition. I know when the cloud just isn't working. It's just isn't a good time for the cloud. So the earlier you can get a sense of that, the better relative to your system. I also get a lot of people who tell me, I was up in this position X% and I just couldn't sleep at night. It was so much volatility, or it was in so much profit. The easy, simple answer 100% of the time is just reduce the position. Any amount, 5%, 10%, 25%, whatever. That will help. I can guarantee you. Just drop it down. Drop it down. It's okay. But I hear that a lot. that is much easier than just ignoring it, which is the other answer. Just forget it exists, right? Just let it go. Let your runners run, But again, this comes back to the individual. So for strategies specifically, the all-weather plans, any market conditions that I like, Williams Fractal's trailing stop loss, I talk about that all the time. We'll hit on that a little bit. TK Cross, I'll talk about that. Divergences being extremely overbought or oversold, just based on common sense or relative to the asset itself. It's important to know. And like I said, with the can't sleep at night problem, just dollar cost average out. Let's say you're up 2,000% on something. Okay. If you're not on leverage, dollar cost average out. If you're on leverage, maybe you reduce that quicker. Maybe you move out of leverage and into spot. There are, of course, tax considerations here that I'm not talking about and usually never talk about, but long-term versus short-term capital gains, also a big part of this for certain positions. And when you're looking for some of these exit conditions, it can be helpful at times and necessary to drop the time frame down. If you look at, not much in crypto right now, but on the legacy side, things like Palantir, you're not really going to get a great read on that on the daily because it's just parabolic. So based on your system, you will probably have to drop that down a little bit on the timeframes. That way you can get a better handle on what's going on. And if you have to do that, that's a sign that, hey, I'm probably in a certain market condition here that I need to be careful if I'm worried about giving some back, or if I have a late entry, or if I'm on high leverage. The difference between some random altcoin and legacy is, yes, legacy will have its down days, but legacy will not collapse on you 50% randomly in an afternoon, whereas some of these high-flying altcoins that are freshly listed, that I tend to avoid, certainly have the ability to pull back significantly for any reason. Before I go any further here, let me mention today's video sponsor, Kraken Pro. Kraken Pro is a complete overhaul of Kraken's trading experience with a one-stop shop for advanced and professional traders. Kraken Pro enables efficient trading execution across multiple markets with a UI that allows for unique optimization tailored to your trading style. You can check out Kraken Pro at the link in the description of this video. Non-investment advice. Crypto trading involves risk of loss. Cryptocurrency services are provided to U.S. and U.S. territory customers by Payward Ventures Inc., PVI, DBA, Kraken. Since the ETFs launched in 2024, there have really been 3 trades that I would consider significant, unless you're trading lower timeframes. There was the post-ETF launch, grayscale, unlock, inverted head and shoulders situation, leading to 2 moves, 8 months of nothing, and then post-election, now we're back to nothing for a few months here. So it's very important to get these right. It's very important not to botch the entry and certainly not to botch the exit. Back to the trading stages of people in general, most people only lose money trading, and most people cannot hold on to a winner long enough to let it continue winning. Okay, so that comes with experience, but there are plenty of people who just consistently close things way, way, way too early when they're winning. This goes back to having a system that's relied upon and having the ability to know when to hold them and know when to fold them, as they say. Something else I also like is fibs, obviously, for exits, keeping that in mind. If you're trading a breakout on high leverage and momentum slows down, just get out of the leverage and go to spot. It's not difficult to do. Again, tax considerations, I get it. But you probably should do something, right? Drop the position a little bit, 25%, 50%. People really struggle with reducing or adding percentages, I think, as well, especially over time. That's another thing people have trouble with. They want to be all in or all out at once. You have to get used to slow rolling some of this stuff, holding it over a period of time, especially if something takes months to break out of a range. You have to give it time to get there. You have to give it time to let it be. Another problem I see with people, they confuse hodling or investing with trading, and they're just holding stuff way too long on high leverage when momentum slows down. MSTR being a great example of that. Anything that's leveraged BTC or altcoins, I'm certainly personally more readily selling quicker than being in my home base on BTC or something like that. But that's up to the individual. So we had our 3 patterns, great. We had our take profit levels, excellent. You're always looking for divergences. You're always looking for reversal patterns. It's always the same 3 or 4 set of things for me. Bearish TK cross, in this case on bullish moves, Williams fractal stop losses, bearish reversal patterns, divergences. If I see any of that, I'm reducing, I'm staying out, I'm avoiding, it's done, right? And again, a lot of people not so great at this, so they tend to be late, they tend to miss the move. This was a 60, 70% move. And so they want to make money where there isn't money, being late. And so then they don't sell the position quick enough when they're underwater. And this perpetuates the cycle over and over and over again. You also have to have the discipline when you're exiting this stuff to stay out till better conditions arrive, right? It becomes a compounding problem when there's so many variables and you don't know what you're doing, right? It just really eats away at profitability. And this level that we're currently in had been the plan for months leading into this breakout. So it's not like it was a secret where this is going to go. I mean, if we fast forward to the gold example, gold's a perfect example of this. This gold setup was there for years. Again, this goes back to reading the room and knowing what's going on with particular assets. But we absolutely had people reducing their gold positions at 2,300 because gold's not supposed to be up that much. Okay, fine. Why do you hold gold in your portfolio at all? What are you doing? If the asset is on a monthly snail's pace molasses in January timeframe, you have to give it time to do its thing. Yeah, it's up a lot, but when it runs, it typically runs for multiple months. Alts, not so much, right? Alts are the opposite end of the spectrum. And if we pull up Solana from 2023 to 24, similar story. I exited this way early based on this target, but my issue wasn't getting out of the position. My issue was going from leverage to cash versus leverage to spot. So that's my teachable moment for myself. On the daily here, entry, exit, stop loss, it was all there on the chart pattern, but the trend kept going, right? I didn't let the runner run. And there really wasn't an exit on this until February 3rd. And again, you have people on something that's already up 800% in mid 24 thinking, oh, this has got to run again. This has got to run again. I mean, this stuff takes time to digest moves. You've got people who've been down on something like Solana for a long time who are finally in profit. And the same can be said about Ripple. This stuff takes time. I mean, what I see setting up on Ripple is a potential head and shoulders here. Absolutely possible. So if I'm sitting in something for years and it pops like this, you better believe I'm out. You better believe it, especially on the spot side. The opportunity costs are just too great. And really, if it looks like this, to me, this could easily keep going. Who knows? Have a system, have a plan, have an entry, exit, stop loss. There's other stuff like this. Okay, Palantir, this is active now. It looks beyond parabolic. I don't really care about the fundamental side ever, but you could argue whatever you want about sales to earnings to price, whatever. I don't really care. It doesn't matter to me. When you're seeing something like this late, certainly not an entry. The viable entries are always either Tenkin or Kijun as far as the touchbacks here. You can see we had I don't know if this was the DeepSeek stuff. I don't think it was. But you had a full Kijun bounce, retracement, mean reversion. Fine. Like that's a decent place to take a stab. Not up here. I don't even care if this doubles from here. Over time, you will do poorly longing charts that look like this all the way up here. On the bottom here, I have a price versus Kijun measurement, and it's telling you how far above or below price is from the Kijun. And if we look historically, X level is tolerated, whatever it is, 30%, 40%. Previously, it was around 40%. Currently here, it's about 40%. So something like this is very helpful, especially when you're in the early stages of this, to level set expectations, saying, okay, yeah, we're 20% over, but we could keep going. Absolutely, as long as we're not triggering Williams fractal trailing stop losses. Now, if you're up 10,000% and you can't sleep at night, maybe just DCA out. Depends on you, depends on the position. But this style of chart is not in the first inning. It's certainly closer to the 8th or 9th inning. Doesn't mean it'll go to zero. It doesn't mean it'll violently pull back. It's just very late. Train left the station. I have a lot of guys lately talking about Hood and what to do there because they're up a lot in a short amount of time. It's the same story. Williams fractals, pop those on. What do they look like? What does the price relative to the Kijun look like? This is pretty stretched here. Historically, not a lot of data, but pretty stretched going back since 2022. Certainly not in the basing phase like it was from 22 to 24. And again, in the later stages of the markup phase, probably. It's not the beginning. I can tell you that. And it doesn't mean this can't keep going and reconsolidate, but I'd have a trailing stop loss plan. I'd have a dollar cost averaging out plan. I'd have a hard level stop plan. Like, okay, if this hits 200, I'm out. If Palantir hits 200, I'm out. That sort of thing. And I keep bringing up Tesla because it's a great example for the cloud plus chart patterns. It's giving you a target on the chart pattern, which it hit. It's giving you a Williams fractal trailing stop loss, which broke down, I don't know, months ago at this point. And then it's giving you a last get the hell out signal with the bearish TK cross pricing cloud. That was at least 4 days ago there. this has nothing to do with fundamentals. It's just technicals, okay? The fundamentals never made sense for Tesla. They make even less sense today. But I think the difference between something like this and a Palantir certainly has a fundamental tailwind, whereas Tesla probably lacks that on the sales side of things. Another great example for exits in the cloud is NVIDIA. Mixture of chart patterns, mixture of trend metrics. Williams Fractals, I'm sure, performed excellent on this stuff, but it's never the same, or it's never different for me. The system has a built-in set of exit strategies, as should your system. There should always be fully mapped out potential plans here so that there aren't any surprises. What happens in a parabolic environment? What happens when we trip the Williams Fractal? Maybe I don't close everything. Maybe I close 75%. And then I close everything on the TK cross, or what happens when we hit the chart pattern level. These are all very specific to me and my trading, which is why you need to establish your own set of rules. But if something like BTC is a multi-year hold generational opportunity, then do that. Do nothing other than that, right? Don't scare yourself out of stuff if you have an established plan and start trading something you shouldn't be trading. But just looking at NVIDIA from the TK cross perspective, you can see where this worked very well a couple times. And since then, it's slowed down considerably. So maybe you take the next signal a little less seriously based on size, based on confidence. Maybe something like an all-time high breach if we see it. Much more important, maybe a full cloud reset is necessary here. But it takes the discipline to stay out of this stuff when you're trading it. And maybe this just isn't worth trading anymore. There's other stuff. There's other ponds to go to where the fish are biting, where you'd be better off. MSTO is another one. Okay, Williams Fractals, Cloud, Pitchfork, all this stuff. It's really the same every time. You had a cloud entry, you had a horizontal entry, you had a measured move, and then it kept going. And it hit 380% in 76 days. And it was outside of the Pitchfork. And then you tripped a fractal here. And then you got a bearish TK cross here. So there are plenty of red flags, and should be red flags for you on your exits for your system. Again, with high leverage, I really like exiting something on the measured move or reducing leverage, and then waiting for the Williams Fractal getting tripped to fully exit the position. Costco is another great example, similar to NVIDIA. It's just gone over and over and over and over multiple years now. It's been bullish. Same rules apply. Maybe you don't size it up the same every time. Maybe you reduce a little less every time, but that's up to you, your trading system, and what you can endure over time. You know, you don't have to make all your money in a day, right? Depending on your sizing, maybe you're exiting something like this a little differently than Palantir, than Hood, that's up here, right? And of course, gold, like I already talked about, gold reached the measured move of the multi-year pattern. Great time to take some off, great time to rebalance off of high leverage into something else. But certainly you have to keep in mind, the momentum is there, the story is there, and it's got targets beyond the current level. So is it highly subjective? Absolutely. It's highly subjective. Welcome to trading. That's why establishing the plan for all scenarios is key. And that's why I've stuck with most of the stuff I talk about, because most of the time it works out really, really great. It's not perfect, but there's a series of red flags that I look for to reduce or cut a position to hold on to those profits. And one thing I'm really good at never thinking about the imaginary profit calculator. I just don't think about it. I don't care. Really doesn't matter to me. It's great to journal about it and analyze it, but I certainly don't think about that all the time. You have enough winning trades over time. You have enough at-bats. That's more important than dwelling on closing positions earlier than you should have. That's all I have for this one. Like, dislike, comment, share, subscribe, and happy trading.